Hey traders, welcome to our latest video. Topics we'll discuss in this episode: SMC continuation order flow, smart money continuation strategy, how to plan entry and exit with SMC continuation approach, criteria and rules for profitable entries, and pro tips to boost your winning trades. If you find this video valuable, don't forget to hit the like button, subscribe, and enable the notification bell so you never miss any updates. We'll catch you right after the intro and disclaimer. So, let's begin. As you probably know, the market is strongly attracted to liquidity, which creates constant volatility and continuous fluctuations. It's a frequent scenario where traders miss out on great trade opportunities solely due to market behavior. For instance, volatility can spike when price approaches their preferred entry level, often leaving no valid entry setup. On the other hand, traders might miss a trade simply because they're away from the screen when price touches their chosen entry zone. Interestingly, price often mitigates the identified supply or demand area and then moves exactly in the direction they expected. This raises an important question: what should we do in such cases? The answer is simple. We should apply the smart money concept's continuation entry strategy to participate in the market and manage trades effectively. Now, let's break down the SMC continuation trading strategy and review the key criteria and rules of this entry model that must be evaluated before executing a trade with strong probability of success. If you miss the change of character or flip pattern, or if price action doesn't present a valid entry setup, then taking the continuation trade becomes the most practical and safest approach to execute trades. Imagine we have a bullish structure on the 15-minute chart, where we are running our market analysis. Price has created multiple breaks of structure to the upside, and if we focus on the latest break of structure, we notice that price left behind a clean unmitigated demand zone positioned at the extreme, with inefficiency lying above. Next, we zoom into a lower time frame, such as the 1-minute chart. We wait for price to tap into the unmitigated demand zone from the higher time frame, react with a reversal, and then form a change of character or flip pattern that signals a shift in market structure. As shown here, price generated a change of character pattern and developed a fresh demand zone on the 1-minute chart, fueled by the bullish leg of the change of character. With this new pattern, we understand that sellers have lost control, and we can expect bullish order flow to the upside. At this stage, we should consider seeking long entries. Now, let's assume you missed this initial entry during the change of character, or you simply wish to add more long positions. After mitigating the demand zone, price reversed and shifted its character upward by breaking and closing above prior structures while clearing multiple supply zones. If you couldn't secure any long entries from the change of character zone, in this situation, the best course is to apply SMC's continuation strategy. To do so, price must break the latest structure to the upside and move through the 1-minute supply zone, thereby forming a newly created demand zone. In this case, I wouldn't suggest placing a limit order directly at that new demand zone because of the potential risk. There remains a strong chance that price could treat this zone as inducement to build further liquidity. Therefore, it's wiser to wait for liquidity levels to form and get swept before price revisits and reacts to our newly established demand zone. What we're focusing on here is a pullback after price breaks the recent structure and develops a liquidity zone, such as double bottoms, triple bottoms, or trendline liquidity, above the newly created demand zone. It doesn't matter if price continues upward and forms another break of structure, or if it consolidates for a while. Once liquidity zones are established above the demand zone, we can then place a limit order at the demand zone. This is because we now have a strong confirmation factor. If price sweeps the liquidity zones formed above the demand zone before reaching it. Identifying a liquidity sweep pattern before price taps into our point of interest is critical. This pattern validates the strength of our supply or demand zone. We rely on liquidity sweeps as a confirmation tool. The logic is straightforward. The market requires liquidity to drive momentum. If price does not sweep liquidity before hitting a key level, it often treats that zone itself as liquidity to fuel momentum. To execute a trade using the SMC continuation entry model, there are 4 essential rules to follow. The first rule states that price must create a change of character or flip pattern after reacting to a higher time frame supply or demand zone. Next, we must wait for a clear break of structure and a zone breakout in price action. The third rule highlights that inefficiency should be left behind when price forms a break of structure. The fourth and most critical rule is the presence of static liquidity zones close to our selected point of interest. In short, to qualify for continuation trades, it is mandatory that all of these rules and criteria are satisfied, no exceptions. Here, all the outlined criteria are satisfied. Next, we place our buy limit order at the highest point of the demand zone, with a stop loss set a few pips below the lowest point of that area. For take profit, the target is the swing high located at the extreme. The continuation entry model gives us the ability to execute multiple trades in line with the market's dominant trend. For example, whenever a point of interest forms that fulfills all the previously discussed criteria, this strategy can be applied for trade execution. However, it's crucial to keep certain key factors in mind to avoid large losses and to ensure high probability setups, which we'll explain in detail in the next topic. As we can observe, price has once again created a fresh break of structure and already broken through the next supply zone, leaving inefficiency behind. This has resulted in another unmitigated demand zone on the 1-minute chart. In addition, we notice that price formed a bullish trendline liquidity directly above our newly established demand zone. Retail traders who depend on trend lines and chart patterns typically enter positions each time price touches the trendline, placing their stop losses just below it. This behavior builds up a significant liquidity pool right beneath the trendline, waiting to be targeted by the market. As a result, many stop losses are concentrated around the trendline and are placed by retail participants. In this scenario, there is a strong likelihood that price will move downward to clear the liquidity sitting below the trendline, triggering retail stop losses. At the same time, this movement helps fill the inefficiency left behind, before tapping into the demand zone positioned at the extreme, where all criteria of the continuation entry model are now met. We can now place our buy limit order at the highest point of the order block, setting the swing high as our take profit target. When executing multiple trades at the same time, there are specific rules and points to keep in mind. Limit the number of active positions to no more than 3 simultaneously. Always remember that the position size risked on the first entry should be reduced by half for the following trades. For instance, if your first trade size is 2 lots, it's recommended to risk half of that, 1 lot, for the subsequent entries. That's it, traders. Thank you for watching this video. I hope you found this video valuable and insightful. If you did, don't forget to give it a thumbs up, subscribe to the channel, and enable notifications so you never miss our latest updates. We truly appreciate your thoughts and suggestions. So make sure to drop a comment below and share the topics you'd like us to cover in upcoming videos. Thank you for your ongoing support. We'll catch you in the next episode.